We'll take one more question. Trial balance of Chatterton on 31st March 20 revealed the following items. Plant and machinery 90,000, purchases 58,000, sales returns 1,000, opening stock 40,000, discount allowed 350, bank charges 75, sundry debtors 45,000, salaries 6,800, wages 10,000, freight in 750, freight out 1,200, rent 2,000, advertisement 2,000, cash at bank 6,900, credit balances, capital account 1,10,000, sales 1,27,000, purchase returns 1,275, discount received 800, loan 5,000, creditors 20,000. As a adjustment they have given, stock on 31st March 20 was 35,000. Well, again if we take a trading account, a profit and loss account and balance sheet, first we'll write trading account for the year ended 31st March 20, particulars amount rupees, particulars amount rupees. Now in profit and loss account, on the top of P&L account, profit and loss account for the year ended 31st March 20, particulars amount rupees, particulars amount rupees. Now on debit side of profit and loss account, we'll classify the indirect expenses into 4 different groups: administration expenses, selling and distribution, financial and other expenses and losses. Coming to balance sheet, at the top of balance sheet we'll write balance sheet as at 31st March 20, capital and liability side, asset side. Well, capital and liability side, first we'll write capital, below that opening, then non-current liabilities and current liabilities. On asset side, non-current assets and current assets. So this is the first step. We have formatted all accounts, guys. Now directly we'll do the posting of trial balance into this accounts and statement. The first item is plant and machinery. It's a non-current asset, 90,000. Purchases, trading account, debit side, 58,000, inner column. Sales returns will deduct from sales in trading account, credit side, 1,000. Opening stock, trading account, debit side, 40,000. Discount allowed, P&L, selling and distribution, 350. Bank charges, profit and loss account, financial expenses, 75. Debtors will show as a current asset in balance sheet asset side, 45,000. Salaries, profit and loss account, administration expenses, 6,800. Wages are direct expense, trading account, debit side, 10,000. Freight in, that means freight inwards, that means carriage inwards is a direct expense, trading account, debit side, 750. Freight out, that means freight outward, carriage outward, it is an indirect expense. It goes to profit and loss account, selling and distribution, 1,200. Rent, guys, but above that they have given debit balances, so rent paid, it becomes our expense, indirect expense. Profit and loss account, administration expenses, 2,000. Advertisement, profit and loss account, selling and distribution, 2,000. Cash at bank is a current asset in balance sheet asset side, 6,900. Now if we talk about credit balances, the first item they have given is capital. So in balance sheet liability side, below capital we have written opening, in that 1,10,000. Then we have sales trading account, credit side, 1,27,000. Inner column, from that now sales returns 1,000 will deduct and outer column will write the net amount. Purchase returns, again trading account debit side will deduct from purchases and the net amount will record on outer column. Discount received is our income. Profit and loss account, credit side 800. Loan, well they have given credit balances and loan credit balance means we have borrowed a loan, it's our non-current liability. So balance sheet under non-current liability, loan will show 5,000. Creditors, it's our current liability, balance sheet liability side 20,000. Now if we take the adjustment, closing stock is 35,000 guys. Two effects of this adjustment, trading account, credit side, by closing stock 35,000 and balance sheet current assets closing stock 35,000. Now if we take the total of trading account, credit side, it comes to 1,61,000 which is higher. The same total we record on debit side, and from debit side if we deduct all items, the net difference on debit side we get is 53,525. This is gross profit. Gross profit if we transfer to profit and loss account credit side by gross profit 53,525. And now if we take the total of profit and loss account credit side, it comes to 54,325. The same we record on debit side of profit and loss account. If we deduct all expenses from this, the net difference on profit and loss account debit side we get is 41,900. This is net profit. Now if we add this net profit with capital on balance sheet liability side, we have written capital, below that opening 1,10,000. With that we add this net profit 41,900, we'll get closing capital 1,51,900 outer column. Now if we take the liabilities total, it comes to 1,76,900, and if we take the total of assets, we'll get the same total 1,76,900.